Imagine making an investment move so unexpected that even your best friends call you crazy. Then, when the dust settles, you come out on top. Intrigued? Stick around because I'm about to review how going against the grain can lead to market-beating returns. Welcome to the program You Can Surpass the Stock Market. Here I show you how you can reach the peak where few arrive in the stock market without getting overwhelmed. I am Francisco and I'm an expert in finding stocks that can top the S&P 500. A contrarian investor is someone who doesn't just follow the crowd's enthusiasm or panic. Instead, they pause and think critically. Is the market overreacting to bad news? Or is the market blindly chasing a fad? They look for undervalued or overlooked stocks, companies the majority of investors have unfairly dismissed. Being a contrarian doesn't mean doing the exact opposite of everyone else with no reason. It's not about rebellion for its own sake. It's about finding good, solid companies whose shares are mispriced because of market swings, short-term fear, or simple neglect. While others might be fleeing a stock after one disappointing quarter, the contrarian asks, has anything fundamentally changed? If not, they might invest at a bargain price. In short, a true contrarian leans on data and analysis, not just gut feelings, to stand strong when popular opinion goes one way and the truth may lie in another. Investing against the tide means moving in the opposite direction of popular sentiment. Picture a rushing river of investors heading straight for trendy, buzzed about stocks. The contrarian wonders if there's an opportunity in the quieter waters, where solid companies overshadowed by hype or fear are trading below their true worth. It's not about ignoring reality. It's about calmly separating fact from noise. If a great company's shares sink due to knee-jerk reactions, or short-lived events, a contrarian might see a genuine chance to buy low. Most people who invest in the stock market want to beat the S&P 500 but end up failing behind. Why? They chase hot stocks at the worst times, or they bail out when the media screams sell. This leads to stress, losses, and wasted energy. Going against the tide helps break that cycle of emotional decision making instead of getting whiplash from the market's ups and downs. You focus on real value. When you stop running with the herd, you often find stability and a more thoughtful approach, reducing that constant buy high, sell low pain. By losing beyond the crowd's noise, you may uncover stocks trading at a discount. When the market finally corrects itself, realizing a certain company isn't doomed after all, your shares could gain value while everyone else scrambles to jump back in. Another benefit is emotional clarity. Contrarian investing teaches you to stand firm on research rather than popular opinion. This approach can build confidence and strengthen discipline, both of which are essential ingredients for potentially beating the S&P 500 over time. Imagine you're at a small town fair. One lemonade stand has a huge line because it's famous and flashy. Right next to it is a quiet stand no one seems to notice. Yet it actually offers bigger cups and top quality ingredients at a lower price. Most people ignore it simply because it lacks hype. In the stock market, many rush to buy shares of well-known companies that everyone's talking about. Meanwhile, a lesser-known business could be quietly performing well, boasting strong financials despite a slump in public opinion. Maybe they had a single bad quarter, or a rumor went around, pushing the share price down. If you dig deeper, like tasting that overlooked lemonade, you might find the product or the company is actually far better than people realize. While the majority stands in line for the big name, the contrarian calmly checks the fundamentals of the neglected stock. If the numbers add up, solid revenue, a reliable business model, smart leadership, this stock may be a hidden gem. Over time, as others catch on and see its true value, the share price could rise, rewarding those who invested while it was still unpopular. That's the essence of investing against the tide, ignoring the noise around the famous stand and looking for real value where few are paying attention. Just like in your lemonade stand scenario, the quiet option can end up quenching your thirst for gains more effectively than the highly publicized one. Many worry that if everyone likes a stock, it must be good. If everyone hates it, it must be bad. Herd psychology makes it thought to peel away from majority opinion, but the crowd can be right or wrong. Markets aren't always rational. Short-term biases can create mispriced stocks. Try a contrarian checklist. Write down each reason why the crowd dislikes a stock. Then methodically gather data, like revenue trends, management strength, or new product launches, to see if each reason is valid. If you find facts that counter the crowd's narrative, you might have a legitimate contrarian opportunity. This systematic approach helps you see why the crowd might be wrong. The reality is, crowds often overreact. They might panic over small setbacks or hype up minor achievements. By doing structured research, you move beyond "they must be right" and into a mindset of "what does the data actually say?" If you confirm the crowd is correct, you'll avoid a bad buy. But if you find evidence they're missing, you gain confidence to invest despite the noise. When a stock is shooting up thanks to a viral news story or a popular CEO, it's tempting to jump in. Nobody wants to miss a rocket ride to quick profits, but hype often inflates prices beyond real value, setting up a nasty fall for latecomers. Picture your grocery shopping. Suddenly, apples become the biggest craze, and their price triples. Do you blindly pay more just because everyone else is? Or do you look for equally tasty but cheaper fruit that might give better value? Contrarian investors do the second. They question the actual worth of a stock before joining the stampede. In the long run, hype-driven spies can crash hard. By staying disciplined and focusing on the stock's fundamentals, you can skip the buy high, sell low trap. True, you might miss some short-lived rockets, but you also dodge the heartbreak when they come back to earth. Meanwhile, you're discovering stocks with more stable growth potential, and those gains often last. People have busy lives, family obligations, full-time jobs, hobbies. Spending hours on financial reports seems overwhelming, so they stick with popular picks that are easy to understand. Introduce research sprints. Break your analysis into small 15-minute chunks. In the morning, scan headlines for any battered or overlooked stocks. At lunch, briefly check one of those companies' recent earnings. In the evening, review a couple of key ratios like price to earnings or revenue growth. Over a week, these mini sessions add up to substantial knowledge. Additionally, use screening tools to filter undervalued shares. You don't need to read every page of a 200-page annual report. Focus on the major points. Is the company profitable? Is its leadership stable? By turning research into small, regular tasks, you can find hidden gems without losing your whole day. What if I'm right about a stock, but the market stays blind forever? It's a common fear. Contrarian investing sometimes takes longer to pay off, and holding a stock the crowd ignores can feel like shouting into an empty room. Think like a gardener. You plant seeds in good soil, give them water and sunlight, and wait for them to grow. Not all seeds sprout overnight. That's why you set a reassessment period. For instance, tell yourself, I'll hold this stock 2 earning cycles. If fundamentals haven't improved, I'll reconsider. That way you balance patience with accountability. Markets do eventually correct themselves, especially if the company has strong fundamentals. By defining a timeline to review your reasons for investing, you won't hold onto a fading dream forever, or bail out right before the market wakes up. Buying a stock everyone else avoids might seem like a wild bet, but contrarian investing is not about random guesses. It's about collecting information others dismiss. Keep a contrarian journal. Each time you make a contrarian move, write down exactly why. What facts led you to believe the company is undervalued? Over time, reading this journal helps you see patterns and refine your approach. You'll learn which signs truly matter, like a healthy balance sheet, and which are noise. This transforms contrarian picks from gambles into carefully considered moves. You have a written record of your logic, helping you stay disciplined. Sure, there's still risk, but it's calculated risk, much different from blind gambling. Following a contrarian path can invite skepticism. Friends or colleagues might say, that stock's a loser, especially if its price drops further. This can shake your resolve. Create a conviction map. List your top reasons for believing in the stock. Example, improving sales, new leadership, cost cuts. Whenever doubts arise, either from yourself or critics, review the map. Have any of those core reasons changed? If not, you might decide to keep holding. You can also share your analysis with a trusted friend who is not emotionally invested in the situation. Their fresh viewpoint can reaffirm your logic or point out flaws you missed. This combination of personal clarity and external feedback strengthens your backbone against the noise. Some think you need secret info or advanced financial models to succeed as a contrarian, but much of contrarian strategy relies on publicly available data, earnings statements, news articles, basic ratios, and the ability to interpret that data differently. Form a mini mastermind group. Connect with a few fellow investors who also favor data-driven decisions. Each of you picks a potentially undervalued stock, shares your logic, and gets feedback from the others. This way you leverage common knowledge in a smarter way, rather than needing hush-hush insider tips. Most crucially, contrarian investing is about reading the same info as everyone else. Only you spot the overlooked positives or overblown negatives. That skill doesn't require secret intel, it just requires a willing mind. Many assume that if a stock is unpopular, it must be a contrarian goldmine. They buy simply because everyone else is selling. This approach confuses unpopular with undervalued. An unpopular stock might be disliked for a very good reason, like flawed products, poor management, or unsustainable debt. If you jump in just to be different, you could be stepping into a money pit. When you buy a stock only because the crowd hates it, without investigating its fundamentals, you risk major losses. The company's issues might be far worse than you realize. You might hold on to false optimism, telling yourself the market is wrong, when in reality, the market is fairly priced in a dime business. This mistake can crush your portfolio and your confidence. You might walk away thinking contrarian investing doesn't work, when in fact you never practiced true contrarian analysis at all. Combine contrarian thinking with structured research. Use an evidence matrix. On the left side, list all the reasons people hate the stock, like drop in sales, a scandal, or big debt. On the right side, note any counter evidence like new partnerships, a strong cash balance, or a fresh leadership team. If the right side outweighs the left in factual importance, not just wishful thinking, then it might be a genuinely undervalued opportunity. Additionally, set up mini milestones for the stock. If key improvements, example, a new product launch, don't happen by a certain date, recheck. This ensures you're not blindly holding onto a bad pick forever. Real research protects you from playing guessing games. You're not just being contrarian, you're being smartly contrarian. This means when the market corrects itself and the stock rebounds, you can profit from the rise. Plus, you'll understand why it rebounded, giving you more confidence for future contrarian bets. Over time, this habit of thorough analysis helps you consistently spot hidden gems while avoiding companies that are truly doomed. Contrarian investors often know it takes time for the market to come around. However, there is a thin line between patience and stubbornness. Some people keep holding a losing stock forever because they insist the market just doesn't get it. In reality, new information might have emerged that undermines their original thesis, but they refuse to update their perspective. If you're stubborn, you might watch your portfolio bleed as you cling to a stock with deteriorating fundamentals. Perhaps a competitor introduced a superior product, or the company's management took a turn for the worse. Ignoring these signs because you're being patient can lead to huge opportunity costs. Money you could have placed in a better contrarian bet sits locked in a losing play. That frustration might eventually push you to abandon contrarian investing altogether. A practical fix is to set exit criteria before you even invest. Write down specific red flags. Example: if the company's quarterly revenue drops for 3 consecutive periods, or if a major customers ditch the brand. These are your deal breakers. If they happen, it's a signal to revisit and possibly exit your position. This way, you're patient enough to give the market time to realize the stock's worth, but not so stubborn that you ignore genuine trouble. Another tip: do a scheduled health check every quarter. Ask, has anything changed that conflicts with why I bought this stock? If your reasoning still holds, keep going. If the main pillars of your thesis are crumbling, it's time to reconsider. By distinguishing patience from stubbornness, you avoid riding a sinking ship to the bottom. You still give your contrarian picks time to prove themselves, but you also stay alert to real threats. This balanced approach can protect your capital from unnecessary losses and ensures you remain flexible enough to move on to new opportunities when your original idea no longer makes sense. Over time, this healthy balance can significantly boost your returns and reduce stress. Some contrarian investors believe they should ignore all market chatter. They think any popular opinion is worthless noise. But while hype or panic can be misleading, market sentiment offers clues about why a stock is unloved. If you tune out sentiment completely, you might miss important details that explain a stock's price movements. If you don't check sentiment, you could buy into a stock right before a major negative event. For instance, maybe people are selling because the company is about to lose a critical patent or its CEO is under investigation. Without scanning headlines, social media, or analyst discussions, you stay in the dark. You might interpret a falling share price as a mere overreaction when it's actually the market responding to real, serious problems. Also, sentiment can signal when the tide begins to turn. If you're not listening, you might miss the early signs of a recovery, like analysts shifting their ratings or respected investors slowly buying in. By ignoring those clues, you lose a chance to time your entry or add to your position at better prices. Trade market sentiment like a weather forecast, not a command. Use tools or platforms that aggregate investor opinions. See how trading volume changes and read short analyst notes. Ask yourself, is this negativity based on a short-term headline or a deep-rooted issue? For a creative twist, maintain a sentiment ledger. Jot down the main reasons behind the market's negative view for each stock. Then, on the opposite page, list factual data about the company's long-term potential. Compare the two. If you see more hype or fear than substance, that's a true contrarian signal. By blending awareness of sentiment with your own fundamental research, you develop a nuanced view. You don't get sucked in by the crowd, but you don't ignore valuable market signals either. This helps you avoid jumping in blindly and also allows you to catch wind of any positive shift before others fully notice. The result? Better timing, fewer nasty surprises, and a smoother path for your contrarian plays to shine. Contrarian investing is ideally a rational research-based process, but emotions can still creep in. Maybe a stock drops 10% in one day and you panic buy or panic sell without checking if anything fundamental changed. Acting on fear or greed in the name of being contrarian muddies the whole strategy. Emotional trading leads to knee-jerk decisions and can turn your portfolio into a seesaw. You might buy in haste when the price tanks, only to find out the company's problems are worse than you realized. Or you might sell early because you're afraid of further drops, missing a rebound that your research originally suggested was coming. Over time, this inconsistency can erode gains and create mental stress. Implement a 24-hour cool down. Whenever a contrarian stock you own or watch experiences a significant price move up or down, Commit to waiting 24 hours before taking action. During that period, revisit your original thesis. Why did I believe in this stock? Then, check if new information actually changes that thesis. You can also keep a rational card for each investment listing the 2-3 biggest reasons you bought it. When emotions spike, read your card. If none of those reasons have changed, it might be best to hold your ground. If new facts contradict your rationale, you can calmly adjust your position. Separating your decisions from immediate emotional reactions keeps your strategy consistent. It allows the facts to guide you rather than headlines or panic. In the long run, this approach can yield more stable results and help you remain confident under pressure. Emotions will always be part of investing, but by channeling them through a disciplined process, you give your contrarian bets a better shot at success. Some contrarian investors do exhaustive research once and assume that analysis stays valid forever. They neglect to follow up on quarterly earnings, product launches, or potential red flags. A stock that was undervalued last year might now be fairly priced or even overvalued. If you buy a stock and never look back, you could miss huge changes, new competitors, regulatory shifts, or declining revenue. Your original contrarian thesis might no longer hold, and by the time you realize it, the stock's price might have already plummeted. Or conversely, you might miss an opportunity to sell at a premium if the market becomes overly optimistic. Schedule a quarterly deep dive for each of your contrarian positions. Every 3 months, spend a set amount of time revisiting the company's latest financials and any industry twist. Do a reversible case each time. Pretend you're someone who thinks the stock is now a bad investment. Can you find evidence that supports this negative view? If it's compelling, you may need to reduce or exit your position. Also, keep an eye on valuation drift. If the stock's price to earnings ratio has soared beyond historical norms, while earnings haven't grown that much, it might be time to reconsider. This ensures you don't hold onto a once undervalued stock that's become overheated. By regularly reassessing fundamentals, you stay proactive and avoid big unpleasant surprises. You also get a chance to lock in gains if the market becomes too exuberant. This disciplined follow up helps you refine your contrarian approach, ensuring you're always basing decisions on current rather than outdated information. Over time, that vigilance can significantly improve your portfolio's resilience and return. Contrarian investors often zoom in on a single company's specifics, like its earnings, management, or products. This is important, but they sometimes forget to look at the bigger economic picture, macro factors. Interest rates, global events, or consumer confidence can heavily influence a company's performance. If you ignore macro factors, you could buy shares in a company whose sector is about to face a massive downturn. For example, if consumer spending is expected to drop due to high unemployment or inflation, a retail company's stock might continue sliding no matter how solid its product line is. You might mistakenly attribute falling prices to market ignorance, when it's actually a reflection of a harsh economic realities. Create a macro checklist for every contrarian stock you consider. Ask questions like, are interest rates rising? Which could hurt companies needing cheap loans? Is the sector historically cyclical? And where are we in that cycle? Are trade policies shifting in new ways that might impact sales? Label each factor as a tailwind, something that helps the company, or a headwind, something that hinders it. If you see more strong headwinds than tailwinds, proceed with caution or size your position smaller. If tailwinds are powerful, it could reinforce your contrarian thesis. By blending macro awareness with company-specific research, you get a fuller picture of potential risks and rewards. This prevents you from buying a value trap that's cheap for good macroeconomic reasons. It also helps you spot truly undervalued gems, companies that may thrive once the macro environment shifts in their favor. Staying aware of the bigger puzzle keeps you from making blind bets and can significantly boost your odds of success. Even the best investors pick losers sometimes, but a bigger error is failing to analyze why a contrarian investment did or didn't work. Without reflection, you're likely to repeat the same mistakes or miss patterns that lead to your successes. If you never dissect your past trades, each one becomes an isolated event. You might keep buying stocks with the same flaw, example, incompetent management, without realizing it. Over time, this can sabotage your returns and keep you stuck in a cycle of frustration. You also miss out on reinforcing good habits that helped you pick winners. Start a post-trade autopsy routine. Every time you close a contrarian position, win or lose, spend some time reflecting. What was your original reason for buying? Did the stock rise or fall? And how much? Did the company's fundamentals or the macro picture shift? Did you ever act on emotion during this trade? Which part of your analysis were right or wrong? Document this in a contrarian journal. Then make an improvement plan. For instance, if you realize you overlooked rising debt levels, vow to focus on that in future picks. If you sold too soon out of a fear, set rules to prevent emotional selling next time. By analyzing each trade in detail, you refine your contrarian instincts. You spot repeat errors, like ignoring certain ratios or missing obvious red flags, and correct them. Likewise, you see which methods worked best and can replicate those successes. Over time, this creates a feedback loop, steadily improving your ability to sniff out true contrarian opportunities. The result? A sharper edge in the market and better long-term performance. A big challenge for busy people is dedicating enough time to research. The 5-minute reverse pitch turns short breaks, like a coffee break or waiting in line, into a rapid analysis session that fuels your contrarian instincts. Choose any stock that's been declining or labeled out of favor. No need to do massive homework upfront. Just identify a ticker that the market seems to be shunning. Quickly gather the main reasons people believe this stock is a loser. Is it slow sales growth? Fierce competition? Maybe a negative earnings forecast? Jot this down fast. Think bullet points, not paragraphs. Now ask yourself, could these reasons be overblown or are they fixable? Spend another 5 minutes or even just the initial 5 if you can multitask. Scanning the latest earnings report summary, a news article, or a company press release. You're looking for a potential silver lining, a new product line, cost-cutting measures, or leadership changes. Pretend you're pitching the stock to someone else in reverse. Here's what everyone hates. Here's why that hate might be exaggerated. If you can make even a modest case that the negativity is temporary or small, you might have a contrarian lead worth exploring more deeply later. You don't have to act on every 5-minute finding. The point is to train your mind to question surface level pessimism. If, after you quick check, you still believe the company's problems are real and significant, at least you confirmed it quickly. If you spot holes in the doom and gloom narrative, bookmark that stock for further research when you have more time. This tackles the biggest excuse, lack of time. By compressing the initial analysis into a bite-sized exercise, you won't discover everything about a company in 5 minutes, but you will break the habit of shrugging off bad news stocks without a second thought. You'll be shocked how many bad news stories boil down to short-term issues, sensational headlines, or market overreactions. Even a brief look can reveal that a drop in profits might be tied to a one-time charge or that competitive threats are less serious than they seem. Next time you have a short break, maybe right after finishing this video, try the 5-minute research pitch on a stock you've heard negative buzz about. Just see if the main complaints hold water or if there's a chance the market's being too harsh, planting the seed for a well-researched contrarian buy. Thank you for joining me on this journey into contrarian investing. I hope these examples, objections, mistakes, and small steps have sparked new ideas for how you can go against the tide and potentially beat the S&P 500. If you found this valuable, click that subscribe button and become part of your community. I have plenty more videos coming, packed with insights on spotting undervalued companies and thinking independently in the stock market. Subscribe now and let's keep moving forward together.